The views and opinions of this program are those of the hosts, guests, and callers. There is substantial risk of loss in trading futures and options, which you should carefully consider prior to trading. We found a fair amount of green on the screen across commodities and livestock trade on Tuesday. The grain markets, with soybean meal the exception, a little lower there. Livestock trade, energies, metals, even the stock market firmed up as we went through the day on Tuesday. Just it felt like a good money flow type of day. But I know there's a lot of underlying things in these markets that we need to pay attention to right now. So let's talk about it. Let's dive in. Joining us for market analysis, Brian Splitt with agmarket.net. Brian, how are you, buddy? Good to have you back on the show.
Hey, I'm doing fantastic, Jesse. Thanks for having me again.
Looking at the market action Tuesday, as I kind of mentioned, really, I mean, everywhere you looked, minus bean oil, it found some green on the screen. It just felt like one of those days that the money flow kind of took hold for various reasons and gave us a positive result really across the board on Tuesday, Brian.
Yeah, right. The inflow today was buying, and some more impressive than others. I would say corn was probably the most impressive as far as closing in the closest proximity to its highs for the day. Soybeans traded a little higher than they settled, maybe about a nickel higher, but still a pretty positive day. And wheat was a little lackluster. There was some minor buying, but even after this pullback that we've seen in wheat, with corn and beans kind of being strong for the last several sessions, we really just didn't see much buying in wheat. So, one of the old positions from the funds has been where they sell wheat and buy corn and beans, right? So you wonder if maybe some of these day-to-day movements they're doing a little bit of that, but corn made it up to some short-term resistance, this 416 area. We had some highs in early September that we had failed from at 416, but charts we're kind of mid-range right now, right? We're 20 off the highs and 15 off the lows at this point, and I think right now the market has a very good undertone of support from exports. That's been a very bright spot. The demand for ethanol moving abroad has been a very big bright spot for corn as well. But we still have kind of that overhang of harvest and the general sheer amount of bushels that are hitting the system that is likely to keep a lid on things in the short term.
And yeah, you mentioned the impressive day for corn, and we closed right at the 20-day 416.5, which I know that's kind of a key resistance point right now in this corn market. I'd love to get your thoughts on this, though. Maybe let's go down this rabbit hole a little bit and looking at spreads. The Dece March corn spread, the Nov Jan bean spread. I know we have options expiration at the end of this week, and then we'll have first notice day, et cetera, next week. I mean, talk about both quarter beans. And when you look at these spreads right now, Brian, is there some opportunity for producers there?
Yeah, so I think there's a lot of chatter about the spreads right now. There's been some pretty good strength in the spreads. And what we mean by strength is, the December contract has gained on the March contract. It's gained on May. It's gained on July. And that effectively has taken a chunk of the carry out of the market. So there's always opportunity for some participants in the market. And so for the individual that has basis contracts, so if you have basis priced off of November beans or you have basis priced off of December corn, and you already know at this stage that you're probably not going to price it, and maybe the beans might be the best example because like we said, delivery period is next week. So any decisions need to be made by Wednesday at the close for the most part, for most facilities. And so when you are rolling a basis contract, let's just say that you have 10 under November locked in. Well, what we saw going into delivery a year ago is the spreads widened out. We eventually went to about 25 cents of carry between November and January. So if you were to roll it at minus 25 instead of 10 under November, now you're 35 under Jan, right? So the opportunity right now is we've seen some strength in Nov versus Jan where it's trading around maybe 10-cent carry, 8-cent carries. I think today we traded maybe as tight as 7. So if you know you're going to roll these basis contracts, this is a very opportune time to do that because you're not taking away from your basis very much, right? So if you're at minus 10 Nov, maybe you'll be at minus 20 Jan or minus 18 Jan, something like that. A lot better than where we were a year ago. And you could further that conversation with corn as well. Again, you have a little bit more time until you make that decision. But my concern is that we actually did see the spreads last year firm up just like this. It was into last weekend last year. And the D's to March actually got as tight as 10 3/4 of a cent of carry. Okay. So what happened in the delivery, we went all the way out to 27 1/4 cents, right? It really punished the producer that had basis set that didn't price the bushels. Okay. And it punished them in two ways, right? The futures market broke. And when they rolled out on that very last day, they added 27 cents to their basis. So I think these spreads do hold some opportunity for a segment of your listener, and that is that particular segment that has basis priced, futures are not, and you may just want to roll these out to January beans and March corn as these spreads trade tight like they are.
Now, with that in mind, what about maybe the other segment that doesn't necessarily have any sort of risk management here, and they're harvesting, they're building corn piles on the ground, we're running out of storage and things like that. I mean, is there anything here for the other segment that's listening in that can maybe try to get some risk management with looking at different spreads or other things? I mean, talk about the other side, Brian.
There is a benefit to maybe another segment too. And you had mentioned the segment of the producer that's going through harvest. Maybe they have bushels that they don't have storage for. The spread is telling you to take those bushels to the market right now. And what they are allowing you the opportunity to do in a couple different ways is to, if you wish, reestablish ownership on paper, right? Or now what you're buying on paper, if you want to go out into, let's say, a March call position in corn, you aren't doing it with March 25 cents above December. You're doing it with March maybe 12, 13 cents above December. So when you're buying a call, you're obviously buying time, but you're also avoiding buying a ton of carry in that call. So there's some opportunity in that. And with the volatility value in corn options pretty stinking low right now, it does allow you to put an option in place, because here's the deal. If you, I feel like I just sounded like, here's the deal, Jack, Joe Biden, right? Here's the deal. If you are going to consider paying commercial storage, right, what's going to happen is you're going to probably be charged 20, 25 cents, depending on your facility, just a dump fee to take it to the end of the year. Okay. Now, a March option takes you to late February. Okay. So from a time perspective, as far as, hey, I want to buy an at the money call in March, it is going to be cheaper than paying commercial storage. You are also eliminating the downside risk of the futures market when you sell the cash and buy the call, right? So I think one thing you are potentially missing out on is basis appreciation, but in a lot of areas, basis is pretty strong. So especially if you're in that category of strong basis, tight spreads, cheap re-ownership, I think that's a very actionable position to be in as well.
We're talking with Brian Splitt from agmarket.net here today on Market Talk. And Brian, I want to think about these markets as we're rapidly getting to the end of harvest and looking maybe through the rest of the year, a little longer term. You mentioned exports earlier. And the export pace has been pretty robust. We've been selling a lot of corn to Mexico and a few other countries in Asia here. Unknown destinations have showed up quite a bit the last 2 weeks. Soybeans, I know there's been some rumors in the trade. China's buying U.S. beans and Brazilian beans kind of split. But of course, the elections could have some impact there. But I mean, I guess you look at the overall export picture and what we've been seeing for activity right now. Does that give a little bit of longer term support to these markets? What do you think?
Yeah, I mean, anytime you have product in the country and then it leaves the country and it's gone, that's good, right? That it's got to get shipped, of course, right? So just because it's on the books doesn't mean it's leaving. But the export pace that we have is a very good pace. Corn was really the one that stood out for a while. Soybeans have caught up pretty strong. You know, there was a very long period of time where we were running without a new crop book for soybeans, period. And then in about mid-July, they came in and China bought a pretty tremendous amount in a 2-month time frame. And they've been continuing to purchase soybeans. So we've actually caught up a pretty good clip to what the USDA's target is, because they're 9% above last year for their export goal for soybeans. And we're not there yet, but we've definitely gotten a lot closer. And if we continue some of the recent paces that we've seen, we'll narrow that gap further. But I think to me, maybe the exports for corn has the potential to be a little bit more longer lasting positive effect than on soybeans, because we're going to run into a brick wall of a South American crop that is really, it's right around the corner. And again, it doesn't feel like it is, but the time frame between our harvest and South America's harvest is pretty short. And we saw what happened last year with a 150 some odd million ton crop. Some of the local agencies in Brazil would tell you it's less than 150. USDA stayed above 150. But regardless of where we are last year, if we grow 170 million tons, that is nearly, or call it roughly 20 million tons more year over year production. Even if they have some weather concerns and it drops to, let's say, 165, you're still talking, somewhere between 10 and 15 million tons more than a year ago. And so, again, we saw what happened with the Chinese buying pattern and how long it took them to actually come to us. And when they did, they came pretty strong. But if we have another 10 to 15 million tons or 20, that could really elongate that buying pattern again from China. So I think the corn exports right now seem to me to be a little bit more of a longer term positive effect. Now, the ramifications of that is we see beans break, corn stays strong relative to beans, and then we plant a ton of corn acres next year. So, that's also got to be in your calculations as you're thinking about long-term planning.
Absolutely. Absolutely. I want to touch on some other markets. You mentioned to me silver has been on fire, gold up on the day Tuesday, crude up about another 1.5–2%. I mean, what about some of these outside markets? Anything of note you're watching there, Brian?
Gold and silver have been extremely strong. And I think silver has a lot of catch-up work to do relative to what gold has accomplished in the last decade or so. I think you have probably maybe 3 separate, distinct bullish patterns on silver charts. When you look at maybe a monthly continuous chart, there's a massive wedge that took over a decade to break out of. There's a head and shoulder bottom that we've made over the last several years, and then there's a big bull pennant that we broke out of recently. So all of these project into the mid 30s or higher. So we've kind of reached some of our shorter term objectives of some of the more minor patterns. But the bigger picture patterns like that major wedge, that could take us into the low 40s as far as measurements there. So, I don't know, we're biting off like $1 a day. So we could be at $40 an ounce in silver very quickly. Who knows? But they're very strong buying there. And I just wonder, there was a recent deal that came out about how U.S. banks are in trouble and there's a lot of unrealized debt. And I think there's a general thought for some market participants in silver that silver has been almost, kept at too low of a price by banks. And so is there something happening with banks where silver positions are being liquidated? I don't know. I'm only speculating, but something is really driving the silver market, and it's got a very strong hand underneath it currently.
How about the livestock trade? Cattle and hogs, good money flow there on Tuesday as well. This cattle market, I've heard some folks use the term bearishly optimistic, wondering if we're getting really toppy here. We got a cattle on feed report at the end of the week. I mean, what's your thoughts in this protein sector right now, Brian?
Actually, bearishly optimistic is a pretty good way to put it. It's like if you look at February, we're at the downtrend that has formed from the highs last September of a year ago, before that major break, to some of the highs that we made earlier this year and into mid-year. So we've got some downtrend resistance. You look at December live cattle, and in general, this market has, this particular contract has had a difficult time around 188, 189. So again, we're flirting with that area. I think we closed at 188 plus today. So you get a bearish cattle on feed. Can we very easily come off of these highs? Sure. I think in order to really stay off the highs, we're going to have to see this cash market break a little bit. I don't see the nearby stuff getting to a big discount to the cash. Maybe some of these deferred contracts can trade at a discount to cash for a while if we see a pullback, but I think the nearbys are going to stay relatively strong. So we've seen maybe December pull back from here to the 182 to 183.50 area on some of the shorter term corrections. I don't think you've got something to take us back into the 170s like we were just at, back in August. So maybe some shorter term corrections. But again, unless this cash market sees something, and who knows, right? We've got an election in 2 weeks. Something could very well change the outlook of the market. But, there's talk about maybe changing the way we do things in the country as far as our diet, right? And we're going to stop potentially using some seed oils, right? And start using beef tallow. And it's something that Kennedy has talked about. But, what if that comes to fruition? What does that mean? What if we start using beef tallow on a large scale? It seems like that would be supportive, right? When you have support in soybean products, for example, right, that supports the general product itself or the item itself. So if we start finding a home for additional usage of beef, I think that would be something that would support that market. So I'm anxiously awaiting to see how that turns out. And that could be something that, really helps the market in general down the road.
Well, and you raise a good point here, and I try to avoid getting too deep in the weeds in politics, for instance, on this show. But I think just a broad thought here is that with the election, just a matter of weeks away and the uncertainty there, I think that the general election outlook is and can add some volatility into our markets more broadly. Right, Brian?
Right. You can talk politics in this setting to me in a forum where it's, hey, how would potential policy affect the market? So I want to stay agnostic as to who might win or this or that. But what we have to be aware of is what some of the policies are proposed to be and how that might affect the market, right? So if we have something that increases demand for a product of beef, then that is good. If we have something that happens where we enter a trade war and demand suffers from that, that would be negative for that particular market. If we were to ban used cooking oil coming in from China, well, hey, that brings back support to a product of something that is going to suffer because of a trade war, right? So there's a lot of nuances to this. Again, no opinion on who's going to win or who I like, but we have to talk policy and potential of how that might affect markets.
Absolutely. It's one thing that definitely needs to be watched closely here as we move forward. Brian, good stuff as always. And I know folks can reach out if they have questions. You guys have a lot of resources, intel, and more all on your website, don't you, Brian?
We do, www.agmarket.net. We're actually doing the conference again in Nashville this year, Jesse. And so we've got our early bird specials for that. And if you want to talk to somebody, 844-424-6758 is our general line.
Brian Splitt, agmarket.net. Always good to talk with you, my friend. Thanks for joining us on Market Talk. Appreciate it.
Yeah, appreciate it, Jesse. Thank you.
Make sure to subscribe to the Market Talk YouTube channel. There, you can watch our latest interviews with the top market analysts in the country, find bonus content, and much more. Just go to youtube.com/markettalkag and hit the subscribe button, or you can search for Market Talk Ag on YouTube.